Okay, good morning, everybody. Today is July 22nd, 10:30 a.m. for our Mortgage Monday call series. This is the fourth Monday here of July, so thank you for joining us on the call. As usual, my co-pilot here is Aaron Wise. We're both at Guaranteed Rate Affinity. Good morning, Aaron. How are you?
Good morning. All's good. All's good. Thank you, sir.
Excellent. Recapping the purpose of this call is a quick 20-minute huddle that we do on the second and the fourth Monday of every month. So we are here in the height of the purchase market here in Chicago. For those of you that don't know, Aaron and myself are licensed outside Illinois as well. So if you have referrals, people buying outside Illinois, those are certainly people we can help as well. We don't typically talk about on this call, but figured it was worth mentioning. So certainly keep us in mind. 20-minute huddle that, the idea here is you guys can be, out at a coffee shop, in the car, tune in, get your lending update for the month. Feel free to throw any questions into the chat that you may have. And with that being said, let's go ahead and get rolling with today's agenda. Aaron, any kickoff words on your side here?
Um, the only thing I would say is it was a busy weekend, but I think we can talk about this here in a little bit. It feels like the tide is turning just a little bit, where instead of a multiple offer scenario with 9 people, you've got a multiple offer scenario with 3 or 4. I don't think that's just in the city or just in the burbs or anything like that. So we can talk about market stuff in a moment, but I'm curious to see if you're seeing the same thing. It's kind of nice to feel a little bit of that deflate. So what do you
Yeah,
think?
yeah, I think it's certainly, very specific on location, property type, those kinds of things. But, at the national level, we are starting to see more, concessions out there. We're starting to see, more price drops in the aggregate. Okay. Now that may be because sellers may be a little bit unrealistic right now. Perhaps someone's trying to get absolute top dollar and maybe they're not getting it, right? So, uh, again, these are national numbers, but what's specific to the market and the property type is going to vary depending on location, those things, right? But we are starting to see the buyers starting to have a little bit more power where, 6 months ago, a year ago, they didn't have much at all.
Yeah.
Cool. So on that note, mortgage apps are actually down 16%. They were down in June as compared to May. That's a seasonality trend that we typically see, right? But we look year over year, June of 23 was 1% lower in mortgage apps versus June of 24. Okay. So, you know, as a reminder, we send out a recap of all the links in the articles that we talk about. But according to the mortgage banker's estimate of new home sales, shows a monthly decline of seasonally adjusted values to a pace of 626,000, the slowest in 4 months. But by loan type, conventional mortgages continue to comprise a majority of applications out there. That's typical to what we see. And about 60% of applications for homes were conventional financing, looking at June of 24. Okay. Um, you know, Rates have started to soften up. They always seem to go down slower than they go up. Um, CPI inflation data came in lighter than anticipated earlier this month in July. The shelter side of the equation was a big help in the CPI report. Financial markets dynamism was evident in the immediate reaction to the 10-year yield, which gave a waterfall dive to a critical level around 4.20 as shown below. So we'll get you that article and graph, but the 10-year treasury is at that 4.2-ish percent. If we see a break below that, and it holds, we expect to see rates continue to soften as a result, right? So, any feedback or anything you want to chime in as far as market activity on rates, Aaron?
With market activity, one thing that came to mind right now is a lot of people that locked in interest rates 30, 45 days ago. We are using that float down provision, specifically on conventional and FHA loans. So essentially for the audience, what that means is, okay, let's say we lock somebody in 45 days ago at 7.25 and 6.99 is available today. We can go and in a lot of circumstances grab that newer, lower offering. So that's huge right now, and that's also a good opportunity for us to give that information back to you guys as the agents, so then you can go and chat with those buyers, and it's a good opportunity to ask if that makes any sense. As far as, so that's one point. As far as the market, kind of a short pause for anybody that's on this call. I think this is a good time to kind of take stock and take inventory of where the year has been, how it's gone so far, and essentially what you want the second half of your year to look like. Like the numbers that you were just going through, John, we do see the seasonality pop up every July, getting into the beginning of August, where, just kind of think about your own lives. Everybody's kind of taking those end of the summer vacations. You've got, baseball tournaments that are happening with the kids. You've got all these things that are taking place where, finding a home might not be at the top of the list. Once those kids go back in school and all those vacations and tournaments and all those summer activities wrap, we usually get a nice boost in the fall market, which is, typically your August, September. Now it is an election year, but if I'm an agent out there right now, I'm contacting everybody that I've been in touch with, maybe getting 10, 12 calls in per day, reaching out to anybody and everybody, trying to figure out what the second half, specifically Q4 of my year is going to look like. Maybe planning a small event for those people that are kind of teetering, and just advertising like gangbusters. Because once we get into November, the goose is already cooked, as they say, right? So this is the time when you want to dig in. This is the last ditch effort. This is, all right, what do you want your 2024 and maybe even beginning of 2025 to look like? This is it. So I just wanted to plant those seeds because I feel like now is the time when people are, they're in a good mood. It's summertime. It's not 105 degrees out, it's 79, it's 82. This is when people want to get out. They want to chat. They want to conversate with their friends, yada, yada. So I'd be out there planting seeds as much as possible. So that's my 2 cents for the day.
Yeah, absolutely. Yeah. And in terms of our process, I just want to underscore what you talked about, that free float down is something that's, specific to guaranteed rate companies like us. If your client's working with a retail bank, they're not going to have that opportunity, right? So with us, you basically get 2 bites at the apple, so to speak. Your buyer goes under contract. We typically advise to lock initially as long as you're closing within, say, 45 days. Okay. And then we keep our eyes open for, another opportunity to drop that rate. And if we see that opportunity, we can drop them 1/4, 3/8, or more, and they can do it at no cost. That's a pretty powerful thing, pretty powerful position to be able to have, because you're protected on the upside, but you have all the benefit of the downside if the market continues to go down as far as interest rates go, right? On that note, we do have a special presentation with Logan Mohtashami, who's the lead analyst for Housing Wire. I love that we have Logan on board. I actually listen to the Housing Wire podcast quite regularly. He's a very dynamic personality. He makes boring things like following the treasury markets and the Fed and all those things. He makes it very digestible, easy to listen to, and actually makes it a little bit fun. So This presentation is tomorrow at 1 p.m. Okay, it's virtual, so we will get the link out to all of you. Please register for it. I think it's an hour on the calendar. I don't think it'll actually go the full hour. But this is someone that has his finger on the pulse of market conditions, interest rates, inventory, pending sales, mortgage applications, all the things that we swim in every day. Okay, so strongly recommend signing into that call tomorrow. It will be recorded, so we can get the recording out to you folks as well if for some reason you can't make it or can't stay on the whole time. But I think it'll be a very valuable call to get in on. Okay. On that note of inventory, Realtor.com reports that active inventory is up 35% year over year. Okay. That's a tremendous sign. Okay. So for the 36th week in a row, the number of for sale homes grew compared with 1 year ago. This past week, the inventory of homes for sale grew by 35.8% compared with last year. So, despite nearly 8 months of growing inventory, we're still kind of comparing to the inventory pre-pandemic. Okay. Pre-pandemic had about 30% more homes on the market. Okay. So even though inventory is up 35% year over year, we're still not to where we were pre-pandemic, and we're 30% shy of getting that. Okay. So still a low inventory environment, but it's headed in the right direction. Okay. New listings, which is a measure of sellers putting homes up for sale, were up 8.8% from 1 year ago. So some good news out there, and hopefully a little more opportunity for our buyers. Fannie Mae stats came out that home prices rose by 3% in the second quarter, okay, which is a pretty healthy number. It's not extreme like we were seeing during the pandemic. But single family homes increased 6.9% from quarter two of 23 to quarter two of 24, which is down from the previous quarter's upwardly revised annual growth of about 7.3%, according to Fannie Mae. And on a quarterly basis, home prices rose a seasonally adjusted 1.3% in quarter two of 24. So bottom line is real estate still a great place to be. It's still a great place to invest your money. And that crash that people are talking about nationally, we're not seeing that. In Chicago, we're not seeing that. Chicago actually has 2 of the top 10 markets as far as appreciation right now, the Chicago market as well as Lake County. Okay, so we're doing quite well here in Chicagoland. Okay. Before we get into the Fed activity and what's coming in the next couple of months, Aaron, anything you want to talk about as far as the stats and topics we just kind of ran through there?
Yeah, I was just making some notes as you were chatting through it, and I feel like all the arrows are pointed towards things being a little bit more friendly for buyers coming up. So, you've got a little bit more inventory that's popping on the market. You've got rates popping down a little bit. You've got, and we'll talk about the Fed here in a second, potentially lowering rates at the end of the year. More listings. I don't know. If I'm really wanting to build my, like I was saying before, Q4, and let's call it Q1 of next year, I'm just licking my chops, getting super excited, calling as many people as I can. All that, and by the way, the call that's tomorrow, that John, you were talking about, if you want to grab data points and have some good data points to give to your clients, why it's a good time, why inventory is popping up, all these things. Really, it's 45 to an hour, but I think what ends up happening is we tend to grab maybe 3 to 5 nuggets out of something like that. And those are the things that we use when we're talking to our customers, right? So if you're kind of struggling right now to have something to you know, I think we all probably know this information, but sometimes giving it to your customer in a way that helps them understand it and puts it in layman's terms. Um, I think he does a really good job of doing that. Um, so again, when you're cruising in your car with, and you're stuck with somebody for 30 minutes and you can throw out some nuggets and get them a little bit more excited. Or if you're calling somebody, you're talking to them for, 15 minutes and they're asking, I don't know, maybe I should just wait till next year, yada, yada. I think grabbing a couple nuggets from that call can be super, super helpful. And when you can layer on maybe two or three different things all on top of each other, um, that point the arrows in the right direction, sometimes that's enough to turn the tide and get people excited. So anyway, just wanted to point towards that tomorrow. I think right now, data and statistics, people are hungry for that information. So it's a good opportunity for sure.
Absolutely. And so what we've talked about before, the old adage, the best time to buy a house was 10 years ago. The second best time is today. Always holds up,
Yep.
right? Um, and, you know, knowledge, information is power right now. And it's certainly a good time to buy a home. I feel like that, part of the conversation, especially in the media, is severely lacking with what we expect home prices to do, especially here in Chicago's market. The people in 26 and 2027 are going to wish they purchased in 23 and 24. Yes, interest rates are higher now than they were, 2 years ago, and certainly higher than they were in the last, call it 15 years. Okay. But just because it's not an easy time to buy a house doesn't mean it's not a good time to buy a house. So, to your point, Aaron, even with those buyers that are looking, late in the fall, early next year, we do a soft pull on credit initially. So it's never too early to introduce us and have that basic conversation on strategy, pre-approval. Soft pull is zero downside to the credit score. Information is not shared with any third parties. So certainly get us involved in those if we can help. Okay. Moving on to the Fed. I hesitate to say this out loud, but I'm quoting the article. Okay. The odds of a Fed cut in terms of the rates by September are nearing 100%. Okay. The traders, so the bond traders, are now 100% certain the Federal Reserve will cut interest rates by September. There is now a 95.3% chance that the Fed's target range for the federal funds rate, its key rate, will be lowered by a quarter percentage point to 5%, from 5 to 5.25 in September, from the current 5.25 to 5.5. Okay, according to the Fed Watch. There's a 4.7% chance that the cut will be a half point lower in September. So, as far as the way the market is pricing this in, this is why we're seeing rates starting to soften up, because the markets are baking in that cut that the article claims is 100% here coming into September, right? So you take those two things together, quarter cut versus a half cut, the market has 100% cut baked into September, which is optimistically, I'm smiling when I say this. I think it's a good sign for the market, right? And that the Fed is very deliberate. They don't want to spook the market in any way, shape, or form. So I feel like they've kind of been looking for reasons to cut over the last handful of months, and it looks like we'll see it in September. Okay. Anything on the Fed watch that you want to chime in on here, Aaron?
No, I'm just rooting for it. I think psychologically, that's the biggest impact. I think, you know, not to pour water on it, but in the past, it's really about, when the market bakes something in, if it goes the way that it's supposed to go, there's not that big of an impact, right? So, it worked in the opposite way before. So now, if we do have the Fed decrease, That's not going to have this massive impact on interest rates, but it's going to be such a big psychological impact for a potential buyer or seller. That's where I think the value is, right? I mean, right now, everybody can see it. Interest rates are more driven by inflation data, by jobs, unemployment. So the more we get, you know, an economy that has, we'll just call it stagnation in it, um, the better our rates are going to get, right? So I think the Fed is just kind of plotting what they're going to do based off that data, and it just kind of put their stamp of approval on it, right? But when you see your news outlets say that, hey, the Fed made a move, I think that's where you're going to get a buyer that's going to think, man, okay, this is some good positive momentum. Or maybe you get a seller that's like, hey, okay, we can trade in this 3.5 for, something in the fives. Maybe now's the time, right? Let's get shopping, that type of thing. So it's just the psychological impact is just massive.
Totally agree. And, to your point, the mortgage rates follow inflation, not the Fed. And because inflation's been coming down, we've started to see these rates come down. Ironically, we'll talk about this on future calls, but the day the Fed cuts, I would almost bet that rates go up on that one particular day.
Yeah.
Okay. Because of the psychological aspect that you're talking about. When that happens, I expect the stock market to go into a frenzy and start trading upwards, which actually makes rates go down in the short term. Okay. So that's a nugget for anyone on the call that wants to, provide value to your clients. Um, you know, this is a major talking point and market expectations that we're seeing out there. Okay. One other thing I wanted to mention before we start wrapping it up with loan program items. Nearly 7 in 10 homes that were mortgaged belong to independent mortgage bank companies like Guaranteed Rate. Okay. That's a pretty steep number. Okay. So, a talking point for you and your clients out there. 70% of companies or of mortgages are going through companies like Guaranteed Rate that are independent mortgage banks. Okay. Lesser volume is going through the big banks or the place where your client just happens to have their checking account. Okay. I think there's a lot of reasons for that. When it comes to transparency, communication, riding shotgun along with you and your buyer as far as strategy on pre-approval letters, dropping contingencies, managing the appraisal process, being able to close in 2 weeks. These are all areas the big banks do not perform nearly as well as companies like Guaranteed Rate. Okay, you're starting to see that out in the marketplace. So when it comes to, hey, which pre-approval letter should we submit? Which lender are you talking to? Feel free to throw that in there. I mean, the market is going to the independent mortgage banks because price, service, execution, reliability, all the things that really, really matter in this market. So, wanted to just touch on that before we get into loan products. So, we are just about 25 minutes in. A couple things just to talk about. First-time buyer programs. We have the $8,000 grant that's available for first-timers based on the address where they currently live. Okay. Never too early to get us involved. Your first buyer consultation, shoot us the address. We'll look it up. No income limits on this program. They can buy anywhere in the United States and use this program as long as they're eligible based on their current address where they currently live. We have another program that's a $3,000 grant. This one is specific to Chicago, and they're eligible as long as the qualifying income is 140% of the median for the area, which in our case is 153,000. Okay, that $3,000 can be used towards down payment, closing costs, buying down the rate. It's instantly forgiven. They can refinance at any time. They can sell the house at any time. They don't owe that money back. Okay. The last thing I wanted to touch on before I kick it over to Aaron on the loan product side is family purchases. So, do you have clients that are looking to purchase a condo for their child that's going to college? or are they looking to purchase for an elderly parent who otherwise wouldn't qualify on their own? We have a family opportunity program where you're going to get an owner occupied primary residence loan in that situation. Say they're buying for their parents that are downsizing, 5% down, owner occupied rates. The parent does not have to go on title. They do not have to go on the loan. They certainly can, but it's not a requirement. Okay, so just wanted to highlight those couple programs. Aaron, any programs you want to touch or any wins that you've had for your clients over the last couple of weeks?
Yeah, the $8,000 grant program came in handy last week. We had a buyer get in a multiple offer, and they needed to give a $10,000 appraisal gap. And so the agent actually had this idea. He basically said, "Hey, even if we do a $10,000 appraisal gap, our buyer's getting $8,000 from you guys. It's kind of an eye for an eye, right?" And I said, not kind of. It is. I mean, it's $8,000 that's coming from us. It makes $10,000 gap seem a heck of a lot easier, So I know we've talked about this a little bit before, but man, if you have an extra $8,000, even a $3,000, it just helps mitigate those issues that come from, the landscape is starting to change a little bit, but you know, buyers aren't exactly getting what they want when it comes to inspection issues. And so, we're seeing a pretty high cancellation rate still after like post-inspection with buyer's remorse. But, if you've got $3,000 to help kind of cushion the blow of, man, this carpet in this room kind of sucks, or we need to repaint this room, or we've got a little bit of water damage that's happening here, or, we got this, we got that. I mean, $3,000 goes a long way, you know? So I don't know. I feel like sometimes we sort of think about it and, hey, it could cover some closing costs or cover some down payment. But lately I've been saying, hey, let's get this $8,000 or let's get this $3,000. Let's touch base post inspection and see if we can use that money to kind of help cushion the blow a little bit. And I just think psychologically going in, it makes the inspection seem not as scary, by the way, because they know they've got a little bit of fluff there. And they can still ask for things to be covered. But man, if it doesn't all get covered, or maybe they get half or whatever, using that grant is a big win. So that's all I got on that.
Absolutely. And in terms of those appraisal gaps, right? I mean, I will typically rush that appraisal. Day we get the contract, place the order, we'll have that appraisal back in a week tops. Ideally, we'll get it back before they even wrap attorney review. So they have that protection in case they do want to pull the plug. We'll have that appraisal back before they wrap attorney review, as long as we have 7 days from the time that we meet, the time that we get the contract. Okay. Additionally, we have a system that can check if there's a opportunity to waive the appraisal entirely. Okay. So if you have, even if you're on the listing side, right, let us know. We'll run the property address with a hypothetical 20% down, and we can let you know if the buyer on that home is likely to have to do an appraisal at all. Okay. So great things here this morning. We have one question in the chat that I will address here. So our parent company Guaranteed Rate actually rebranded the name of the company to just Rate, R-A-T-E. Okay. Our side of the company, Guaranteed Rate Affinity, is not affected by that change. All of our marketing stuff is going to stay the same. Just the parent company is going to be rebranded to Rate. So nothing changes here on our end. We're at 30 minutes, so we're going to go ahead and wrap it up. Thank you once again for being on the call. We will get the recap out to you folks later today in an email. The next Mortgage Monday call comes in the second Monday of August, which is August 12th. So stay tuned to your inbox. We'll get the invites out. On behalf of Aaron Wise, my name's John Mooney here at Guaranteed Rate Affinity. Thanks for being on the call. See you in a couple of weeks, guys. Have a great one.
Thanks, everybody.